Silicon Valley Bank.
Silicon Valley Bank.
SVB.
One of the downsides of low interest rates, and I've been warning about this, and that's why we don't own financials in our brokerage account. I mean, we stayed away from the financials for this reason, because lots of people were saying higher interest rates are going to be good for financials because they can earn more money. I was one of the few people out there that said, no, higher interest rates are going to destroy financials, because most people in the investment banking business don't even understand their own industry. Why do you think so few people knew that the 2008 financial crisis was coming? I understood the weak position that the banks were in during the housing bubble, and I understood how weak their position was now going into this coming financial crisis. Everybody else, the banking system is sound, it's sound. It is completely unsound. Here is the flip side of low interest rates. While interest rates were really low, all of these banks, in order to earn income, had to take their deposits and invest them in low-yielding paper. They bought a lot of government bonds, treasury bonds. That's what they had to have. That was considered excellent collateral, right? Full faith and credit of the U.S. government, except they didn't buy short-term because there was no yield there. The yield was at zero. So what did they do? They bought 10-year treasuries, 30-year treasuries at maybe 1.5%, 2%, not a lot of yield, but better than nothing. So they bought all these bonds. They also loaded up on mortgages, either the ones that they originated or they bought them in the secondary market, mortgage-backed securities. Personally, I've got a mortgage on my Connecticut house. I got a 30-year fixed. And maybe there's 25 years left on it, 26. I'm not sure exactly. But I'm at 3 3/8. The current mortgage rate is 7%. What do you think that mortgage is worth? If Bank of America, which owns my mortgage, if they wanted to sell that, they're not going to get anywhere near what it's worth, anywhere near what they've marked it on their books, because they're not marking that loan to market. No, they're pretending it's still worth what I owe them, but it's not worth that. I mean, yes, it's worth that if they hold that mortgage for the next 26 years, but what if they need to sell it? What are they going to get? What can you get for a mortgage at 3 3/8 when the current market is at 7? That's the position that Silicon Valley Bank was in, because a lot of their depositors wanted their money back. Now, one reason is they bank a lot of tech companies, and these tech companies are in a lot of trouble. They're losing a lot of money, so they're tapping into their bank deposits. Maybe they deposited some of the money that they got from selling stock to a bunch of suckers, but now they need that money to cover their losses, so they go to their bank and they ask for the money. Now, the bank doesn't just sit on the cash. In order to get the money, they got to sell their mortgage-backed securities. They got to sell their U.S. treasuries. Well, what are they worth? A lot less than they have them on their books. That's why they lost a lot of money, and now they need help. But there's also something else that's going on. And this is another thing that I predicted. The interest rates are going up, and you can get almost 5% now on a treasury bill. Money market yields have moved up a lot. But if you've noticed, if you have a bank account, your bank is barely paying you any interest. Maybe you're getting 25 basis points, 50 basis points. You're not getting anywhere near what is currently being offered by the U.S. government on treasuries, on bills. Why is that? Because the banks can't pay, because they've already loaned out all the money and they're locked in at these low rates. So they can't pay their depositors enough interest to compete with the U.S. government. So what is that going to do? That's going to create a run on the banks, not just on Silicon Valley Bank, but all these small banks, these regional banks. People are going to start pulling out their money. Now, the small depositors, guys got a couple of grand in a checking account, probably doesn't care about interest. But you've got some of the larger deposits, like this bank. Most of the deposits were big. They weren't covered by FDIC. If you can get 5% or 6% eventually, in a money market somewhere, but your bank is only paying you 50 basis points, just pull the money out, send it someplace else. The problem is the bank don't have it. They got to sell something to get it, but what they're selling isn't worth what they owe you. We have so many U.S. banks that are completely insolvent right now. because none of them are marking their loans to market because they have them qualified as hold to maturity. Oh yeah, we don't have to mark this to market. We're just going to hold it to maturity. Well, sure. But what if you can't? What if you face a situation where your depositors want their money? Well, now you've got to sell, and then you don't have their money. And here's what I think is going to be happening over this weekend. As the news reports go out about this bank failing, which is the first bank failure, big bank failure since 2008, right? FDIC failure. I think a lot of people who have money, particularly at the regional banks, maybe not yet at the big banks, right? But the smaller banks, because this, wasn't Bank of America or Wells Fargo, but it's still a big bank, But I think a lot of people are going to think, wait a minute, this bank just failed out of the blue. No advance warning, rated best bank in America by Forbes, and a month later it's insolvent in receivership. All these people who had accounts that were worth more than $250,000, they can't get their money. You know what? I'm going to go get my money Monday morning. I'm going to take my money out of the bank. If I have $500,000, $1 million, $2 million, I don't want to take any chances. I'm taking my money out of this little bank, and I'm going to put it into maybe a bigger bank, or I'm just going to buy treasury bills. I'm going to get it into a money market. I got to get out of this bank. Well, now all these banks are going to face the same problem that Silicon Valley Bank had. Where are they going to get the money? They got to sell their low-yielding paper at a big loss. And now they're insolvent too. See, everybody was talking about how great it was that all these Americans got to refinance all their mortgages at low rates. And I was pointing out for years, it's great for the borrower, but it's a disaster for the lender. I was saying for years, what is going to happen when interest rates eventually rise and all these banks are stuck with this low-yielding paper? Sure, when they were able to borrow from the Fed at 0 and then reinvest at 2%, well, they still made money. But when it costs you 5% to borrow from the Fed and all your deposits are yielding 2%, 2.8, whatever they are, and your customers want a competitive rate of interest, after all, we're living in a high inflationary environment. You got to pay up. You got to pay a higher rate of interest when there's a lot of inflation. The banks can't do it. And so what was good for the borrowers is a disaster for the lenders. The problem is all of these lenders are backed up by the U.S. government. What's going to happen to Silicon Valley Bank? Who knows how much this bank has actually lost? But the insured deposits are protected by the FDIC. Well, where does the FDIC get its money? From the government. Well, the government is broke. The government is already running a massive deficit. So where would the government be looking to get the money to bail out the FDIC? Well, normally from the Federal Reserve. But the Fed's doing quantitative tightening. That means there's no money there. The cupboard is bare. So where is the FDIC going to get this money? It can't get the money. That is the problem. The banks are going to fail, and there's no way for the FDIC to bail them out. Now, of course, they will bail them out because the Fed is going to reverse and supply the money. But you know what? Depositors are screwed either way. Because if the Fed decides to keep fighting inflation, which means it can't bail out the FDIC, well, that means there's no money in the FDIC. And if the government is going to bail out the FDIC, it's going to have to sell the bonds into the private sector. And the sale of those bonds will put even more downward pressure on the bond market, which will cause even more banks to go insolvent. And the ones that are insolvent will only be deeper insolvent. So if the government has to sell bonds to bail out all the banks that own bonds and are losing money, it will exacerbate the losses on those bonds, making the problem worse. So that's out of the question. But if they can't do that, then you're not going to get your money. The FDIC has to default and depositors lose their money. Now, what they may try to do over the weekend is say, we're going to insure all the big deposits. Doesn't matter. Forget the limited 250. We're going to insure everything just to try to stop a run. But again, where does the government get the money to insure everything? They don't have it. That means now they have a much bigger liability if they're going to insure all deposits, not just the deposits that are less than 250. But let's say the Federal Reserve does pivot, goes back to quantitative easing, so everybody can get bailed out. So none of the depositors have to lose their money. well, then the deposits lose their value, because then the dollar is going to crash. It is going to just collapse because inflation is going to run rampant. Because if the Fed has to pivot now, if they have to cut rates to go back to QE, when inflation is nowhere near 2%, finally the world is going to wake up to what I have been warning since before the 2008 financial crisis. And by the way, all the people who want to say that I was wrong going back in 2009 and saying, hey, Peter Schiff was wrong because he was predicting massive inflation as a result of QE. I wasn't wrong. I was right. QE was massive inflation. Now, most people don't understand what inflation is. They're just looking at the CPI. And they said, well, Peter Schiff was wrong because the CPI was not going up a lot. It was just going up 2%. Well, now it's not. Now it's going up 7, 8, 9%. There was just a longer lag than I thought. But this is it. The inflation chickens have come home to roost, and now we're going to have to deal with the consequences. Everything I predicted is going to happen even worse, because during the 10 years that everybody thought there was no inflation, and so the Fed kept printing money, there was inflation. It's just that the consequences were being delayed. But now they've created so much inflation because they thought they could, because they didn't think it was a problem. Now all of a sudden all that inflation is just now starting to catch up with us. And it's not going to go away. There's only one way to try to eventually bring this under control, and that is massive cuts in government spending, which are not even on the table. And in fact, I was listening to an economist on YouTube, and I forget the guy's name. He was pretty good. I wish I remembered his name because I'd give him credit. But, he was talking about the idea that deficits don't matter. Cheney came out, and said Reagan proved that deficits don't matter, right? Which, of course, was BS. But this guy, said something similar to what I've been saying, but I'm going to, I was just listening to him, so I'm going to credit him, whoever he was. But anyway, the guy said, well, yeah, deficits don't matter as long as the buyers of government bonds have confidence that the government's going to pay the money back. So big deficits didn't seem to be problematic because people still felt that we could pay. Now, I've known that we couldn't pay for a long time. That's been obvious, but apparently a lot of people didn't figure this out yet. But at some point, and I think that point is going to come very, very soon, people are going to realize that we can't pay. And then the debt matters, because now we have a debt crisis. And what's about to happen, this financial crisis, either we're going to have a financial crisis right now, or the government is going to do something to try to prevent that financial crisis. But either way, it's going to set this loss of confidence in the bond market into play, and in the dollar. We get a dollar crisis and a sovereign debt crisis, because people are then going to start to question our ability to repay this enormous debt. Because everybody knows now, or they should, that there is no political will in Washington to either raise taxes on the middle class or cut spending, reduce middle class entitlements. Nobody will touch government spending. The only taxes that anybody will raise are on the super rich, but that's only the Democrats, and not even all the Democrats, and the Republicans won't do that. There is no way the government's going to get extra tax revenue. Even if they tax the rich, it's going to backfire, and they're going to end up with less revenue from the rich. But nobody will tax the middle class, not even the Democrats, at least officially. Sure, they'll do it through inflation, but they won't do it honestly in order to repay the debt. Again, remember, we have this debt crisis going on right now where we have the debt ceiling. And what is every Democrat saying is going to happen if we don't raise the debt ceiling? We're going to default on our bonds. Nobody is saying that if we don't raise the debt ceiling, we'll raise taxes so we can pay our bonds. Nobody is saying we're going to cut Social Security or Medicare so we have the money to pay the bonds. No. The very first thing we're going to do, if we can't borrow more money, is default on what we've already borrowed. Again, this is the official acknowledgement that we are running a gigantic Ponzi scheme and that we will never pay off this debt. And so, very soon, debt is going to matter. deficits are going to matter, just at the point where they are spiraling out of control. And inflation is here to stay, right? Because as we have to monetize more debt, which is exactly what they're going to have to do, because they got the whole country hooked on this cheap money. And the only way to avoid a massive financial crisis that is on an order of magnitude greater than 2008 is to open up the spigots and create even more inflation. But we've already got a huge inflation problem. And what the government would have to do to prevent a financial crisis is take that huge inflation problem and make it much bigger, and then set off the potential for a sovereign debt and currency crisis, which ultimately could produce hyperinflation. Something I warned about after the 2008 financial crisis as a worst case scenario. It's now more likely than it was back then, given everything that's happened during the 12 years, given all the additional rounds of quantitative easing, especially what we did during COVID. Right? If we weren't screwed then, we are now. Because what we did then was, overkill to a great degree. So we've definitely overdosed on this stimulus, and we are going to experience the consequences. So a lot of people are just downplaying this. It's no big deal. This is exactly how the 2008 financial crisis started. First, it's just one thing. It's just a subprime lender that went under. Don't worry about it. This is the beginning. This is the tip of a huge iceberg. There's going to be more failures, more defaults, and then, all of a sudden everything falls apart and people get it. And the question is, will the Fed react prior to an implosion or after the implosion? That I don't know for sure. But I know that it's not going to sit back and do nothing, because everybody is just counting on the Fed. Everybody thinks the Fed has the tools to save the day. It doesn't. The reason we're in such a horrific situation today is because of the Fed and its tools. It didn't fix the economy, it broke it. But people didn't know that because we just postponed the consequences. We numbed the economy up to the pain. And so we didn't feel the pain as we got sicker and sicker and sicker. But since the politicians, they don't want to do anything, they don't want to cut any spending, they don't raise any taxes, so they just assume the Fed could do it painlessly. And they've been lulled into this false sense of confidence that the Fed can keep doing it. They don't realize that it's out of tricks, right? That the illusion of inflation isn't going to work anymore to mask these problems, because now inflation is the problem, and you can't solve the other problems without exacerbating the inflation problem, and that's it. This is the end game for the Fed.